Morning, everybody. I'm Steve McGregor, Business Development Director for Tavistock Wealth, and I am delighted to be joined today by Jonah Levy, our Portfolio Manager for Physicals. Jonah, how are you?
Morning, Steve. Thank you very much for having me on. I'm well, thank you. Surviving the second lockdown, trying to stay active physically, mentally, and doing a good job, I think, and happy to be here.
Well, you're looking well. You're looking well for it, apart from that thing that's growing on your top lip.
Yeah, we don't talk about that. We don't talk about that.
How much have the team raised so far?
We're above £800 now as a team. I think through a combination of facial hair and long runs, we're getting up to that four-figure mark. So, yeah, we're happy with our progress.
Good man. It's a worthwhile cause, and you look quite sartorial as a result of it, a bit elegant with it. So you carry it off well. Anyway, enough of the backslapping, enough of the compliments. I guess the first thing to talk about over the next, say, 15 minutes or so, is to just cover off the area that you're responsible for within the investment team. And I guess the easiest and most appropriate question, first of all, is what is Physicals? And I guess we're not talking Olivia Newton-John here. So can you let us know what we mean by that? What do you cover?
Of course, perhaps that would be more fun, but no, I suppose physical assets from the perspective of Tavistock and the investment team really focusing around two major asset classes, and that's the real estate side of things, property, both commercial and residential, and then obviously you're looking at physical commodities, those that actually exist, and that's everything from agricultural products, corn, soy, sugar, and then through to oil, precious metals, base metals. So really a whole spectrum of what's out there in the environment. And I think with the advent of ETFs and the way that we manage the money using ETFs and ETCs to leverage our investment decision, we can now do that to a much more accurate degree and to a much greater niche than we perhaps ever had been able to. There are REIT ETFs, real estate investment trust ETFs, so that would allow you to gain exposure from US residential property companies, or you could look at Chinese commercial property companies. And so through those ETFs, you can gain exposure to all types of property markets on the residential and commercial side. And then in the commodity side too, there's constant innovation in creating products that track both the spot price of various metals, oil, energy, all of that's kind of that side of the thing. And then also contracts that will you'll be able to look at whole indices. You'll be able to try and track the Bloomberg Commodity Index as a wider index. And I think these are things that for institutional investors like us who aren't necessarily specialized in one particular asset class or another, it allows us this product library, this suite allows us to really gain that exposure that we want to. And I think that's part of my job since I became in charge of physical assets about a year ago now, is building that product library out and realizing how through physical assets can we actually gain the exposure we want to various economies, to various industries, or value growth, that kind of sectoral shift as well. And then I think my job expands somewhat beyond that, just physical assets, and I like to help to use what I've learned to leverage other decisions made in the investment team. So that's in equities, in fixed income, we're constantly, I like to think, using the stuff we're learning in the physical space to adapt and tweak our exposure. I think, for example, with gold very quickly, which forms a base component of our commodity part, our physical exposure, we can play that through either tracking the physical spot price of the commodity itself, which is what we're currently doing in the Acumen range, or we could track it through an equity play, for example, looking at Canadian mining companies and how they're doing. And so through what we learn in the physical space, we can merge that into the rest of the proposition. And I think that ability lets us sort of be nimble. It lets us optimize where we want to be on that curve. And then by physical assets, I suppose it's what are physical assets now and what physical assets may have been 20 years ago will be very different to what we'll see in the future, be that 5, 10, 15 years to come. And I think that's basically the commodities and the assets that are in demand now will obviously continue to be so, but you're looking at things like battery indices for electric vehicles, you're looking at clean hydrogen, clean water, and these are all markets being increasingly commoditized as sort of resources dwindle, our population continues to grow, and therefore these are continually being traded and products are being added onto exchanges that let us sort of track that and follow that. And then even with products that I think are still existing, so you have your spot gold ETC, which will track the spot price of gold. There are now launching on exchanges sustainably sourced products, so it will be a sustainable gold ETF or innovations that will allow clean metal indices to come in. So I think the physical asset space is constantly evolving. I'm very happy to be a part of it. It's something I've sort of watched and followed for most of my life. I'm a big gold bug. love metals, love shiny things. And so I think physical assets are fascinating. I think with the geopolitical environment we've got going on at the moment, with lots of tensions, obviously, between major economies, there are opportunities, real opportunities. And I like to hope we've captured some of that so far in the Acumen portfolios, the MPS, the protection portfolios. But there's a long way to go. And it's a very exciting place.
It's clearly a huge area, and I think maybe very naively, a lot of people might think, we're looking at physical assets here, we're looking at real assets, we're looking at bricks and mortar property, bit of gold, bit of silver, what else is there? But you've touched on loads of areas there. Clearly got a great passion for it and a great knowledge for it. But before we come on to what's happened to physical assets this year, because I say this every time I talk to one of the team, it's been quite a year. But just in terms of the breadth that we're able to get exposure to within the Acumen portfolios through an ETF or an ETC, an exchange traded commodity, what does that bring to the portfolio that perhaps we wouldn't get if we were restricted to, I don't know, closed-ended or even open-ended funds in the traditional fund space rather than having an ETF?
Yeah, no, absolutely. I think for your bog standard open-ended fund, as you've said, it can be very difficult to gain exposure whilst we're still talking large sums of money here. On a relative basis, some of the trades we would be making into copper, for example, are smaller than a lot of the big players who would be in that space usually, and they have the leverage and the capital and the resources to house that copper and to then trade that copper, look after it. But we obviously as an investment fund don't have that capacity. But what we can do with these ETFs and ETCs is engage in these markets in a way that you do not need this infrastructure to gain exposure to the price of these metals, of these commodities. And it's doing so at a much lower cost. I mean, you're paying, I think, less than 15 basis points to hold gold in the portfolios. Obviously, you're holding paper gold rather than physical gold, although it's physically backed by the exchange and by vaults. And so I think it allows us to enter markets where institutional investors would not have been able to get into, whereas it would have been specifically for specialized hedge funds and specialized commodity traders. And so this advent, and as I said just before, these products are continuously being developed and continuously being improved at a lower cost and allowing us to access more of the market.
We maybe go off on a tangent here slightly. Thank you for that. But in terms of people's understanding of ETFs and the various different ways in which we can use the instrument within portfolios, I think a lot of the questions that I get asked by some advisors is, is there a risk there? What about the more esoteric ETF markets and esoteric ETF holdings? And I guess it plays out in the whole rationale behind, the way in which we run money and we use this vehicle in order to gain exposures. We're looking at ETFs with depth, with liquidity, with the ability for the end client to get their money back if they want to. Can you just touch on that? Because it strikes me, rather than just having an S&P 500 ETF, huge depth by one of the biggest providers out there, that we will have more esoteric positions. So can you just touch on the whole liquidity side of things to give some reassurance to advisors and end clients?
Yeah, absolutely. Definitely in the ETF space, if you look at total millions or billions or trillions of dollars held within various asset classes, equities and fixed income definitely trump the commodity space. But I think the sheer flow of institutional money using ETFs, as well as retail money using ETFs, has provided a deep liquidity in the commodity space. For example, the gold ETF that we own has got over $1 billion of AUM. It's backed by JP Morgan, has physical gold in the vault. And yes, of course, there's volatility and there are downside risks to that, but these are all managed and it's in a UCITS compliant format. And therefore, all of the products that we would invest in have definitely got sufficient liquidity. They're traded very regularly. And we're obviously also constantly monitoring various thresholds and ownership levels to ensure that we fit within the UCITS guideline. And also we're not taking unnecessary risk in the portfolios. If anything, I would argue that the commodity carve-out is actually adding diversification, the physical assets we hold, and providing sort of some protection against equity market volatility or fixed income volatility. And I think that's where the carve-out and the physical assets we hold have really proven their worth over the last 6-8 months.
I agree, and we've written extensively about that. There's a really good blog called The Commodity Carve-Out, which you're referencing there. So do have a look at that on our blog site. I think it's really important to say that it offers this asset class, or these asset classes, offer great diversification within portfolios, but also we've got that mindset not to fall into the trap that that some have fallen into in being able to deliver liquidity back to clients if they need to, because we're dealing with the retail client who might need their money back tomorrow or within a week. So that's really important to highlight. Okay, so we've talked a little bit about that. This is going to be a very open question. What's happened to physical assets this year? And try to keep that to within a few minutes if you possibly can.
You have 3 hours? No, yeah, completely. And I'm sure everyone else, obviously, I've listened to the other calls you've had with Circa, with Alex, with Andrew and with James, and they sort of start, oh, this has been a crazy year in X in equities. And yes, of course, it's been no different in commodities. Over the top at a big macro view, I think commodities move in these larger, slower cycles than equities or fixed income. And I think the fundamental environment moving into this year was one that was quite constructive. We were seeing lower for longer interest rates. We were seeing what looked like the topping of the US dollar and perhaps weakening. Subsequently, we've seen it strengthen through the virus, and now we're in a recovery, and the US dollar is trending weaker again and is moving in the way that we had predicted. But the environment for commodities leading into this year, I think, was one that was strong. We'd held some positions in precious metals and some oil exposure last year, and that had performed well for us. And we sort of thought, a gentle continuation of the norm, and we were happy with our exposure. And then, of course, the dreaded COVID-19, hit, and markets moved all over the place. I think a good barometer or a good indication of what's happened in the commodity markets this year would have to be the USO, the US oil palaver, for lack of a better word, where at the end of April, WTI oil, which is traded in physical barrels rather than paper, which is the Brent crude contract, it turned negative overnight. And I suppose we can talk about that now and say, oil prices turn negative. That's a big deal. That's a big deal. And it really came from a function of this large US oil fund being the short end of the futures curve and not being able to roll their contracts because no one could take delivery of all this oil that was being consistently pumped and shipped, but there was no demand for it. And I suppose on the back of that, oil went negative, people lost their jobs, there was calamity in the markets. And I think whilst since then hot fix stopgaps have been put in place by regulators to prevent that happening again, funds now have to take exposure across the curve and contract wise as well. But I think it's indicative that volatility has been way outside of usual bands. And I think that's the same for every asset class, but it's definitely been no different in commodity land. Those that have had a fundamental strong case, those I think in the electric vehicles index, commodities that have suffered perhaps over the lack of a stronger dollar for the last few years have continued to shine. I think the fundamentals have outweighed the volatility. If you look at some niche things such as rhodium and palladium, rhodium's up 100% on the year, really strong demand for solar cells and for electric car batteries. These are sort of smaller niche markets that we can't necessarily or don't necessarily play from a volatility and a risk perspective, but though there have been shining examples in the markets. However, of course, the big barometer or the big one that everyone talks about is oil, and energy prices for both Brent and WTI are still down 30% on the year, whereas equity markets have recovered slightly. Precious metals, which I think is a large area that Tavistock, at least the investment team, have focused on, I think that stems from the same desire for quality, desire for defensive assets that will continue to perform well despite geopolitical uncertainty, despite weak fundamentals. So gold's up 25% on the year, silver's up 35, I think just a bit more now, 35% on the year. And we've had exposure to both of those for the majority of 2020. Oil prices are very interesting. I think what you're seeing now is a slight divergence away from perhaps fundamentals. If you were to look at inventory levels in Cushing, parts of the US, you might be a bit more worried about oil prices moving forward. But however, what you've seen is on vaccine days, I like to call them, when Pfizer or Moderna or Oxford have released a new vaccine, you've seen oil pop 3, 4, 5%. And I think that you can see there is people are really treating oil as that barometer for equity market performance. The correlation between the two, the S&P and oil prices, has been stronger now since any time before 2008, past 2008 in the last decade or so. And I think that's indicative that people are still playing commodities rather speculatively and are constantly adapting. We have, on the physical side, I think it's slightly different from equities or fixed income, where you're looking at both supply and demand at the same time. With equities, a company is a company, it's either there or it's not. But with copper, for example, one of the trades we still have active in the portfolios, you're constantly trying to weigh Chinese demand versus South American supply, COVID lockdowns, strikes, changing legislation in South America. And so you're constantly trying to balance all of these things. And then I suppose on the real estate side, which is the second side of the commodity coin or the real asset coin, we're still definitely a little bit more bearish on that. Obviously, there's been the evolvement of the work from home lifestyle. Is it the death of the office? All of these things, people aren't taking new leases out on commercial real estate. There was initially, I suppose, a big push in residential real estate when those who could afford to do so, and those who deemed it necessary to do so managed to escape the big cities. You've seen property prices in New York and in London fall quite significantly, but as an index, generally residential housing has held up quite well. So it's really just a shift away from urban areas, but that's sort of been priced in now. People who have had the money to do so have done that. And so we're still not very constructive as a whole on real estate, because I think we still see, whilst the vaccine has come through or beginning to come through, and we start to see sort of a normal of the economy, you hear stories every day of another big firm that says, okay, now we're going to be working from home, and we may have a smaller satellite office, but footfall on the ground is much lighter. The high street shops are suffering. And so I think we've stayed away, as part of this defensive high quality tilt, we've stayed away from real estate to any major degree so far this year.
Yeah. Thank you. That's really helpful. Touched on a couple of the things that I was going to ask you about, so that's great. So in terms of current positioning, what do we like? What do we dislike at the minute, or like less? What opportunities have we got in the months and years ahead? And what are the risks? And I think you've touched on a couple of those bits, but if you could summarize those areas, that'd be great. Yeah,
absolutely. In terms of our portfolios, as I said, we've approached from quite a defensive standpoint this year. Currently, we sold our silver exposure relatively recently after meteoric gains through the majority of 2020. Lucky, good timing, whatever it was. We enacted the silver position early in June, and since then it did nothing but outperform the benchmark. It came back a bit. We've since sold it, capped a nice profit on that position. And we still hold gold. We hold gold in a scaled weighting across the proposition, physical gold backed by bullion. And this is a much more defensive, lower risk play than, for example, being in the gold producers ETF, which is an equity-based proxy for that position. Gold continues, I think, from a long-term fundamental perspective to shine. I think we will see further monetary stimulus. We will continue to see lower interest rates. And I think the amount of stimulus that we have seen be pumped into the economy already is fueling fears or hopes, depending on which side of the coin you're on, of inflation. And therefore, the value of gold as a store of wealth becomes ever more important. And it's a combatant to central bank policy, and therefore we continue to hold it for both inflationary hedge reasons, but also diversification away from both traditional fixed income and equity markets. Copper is, I was listening to Circa's call with you last week, and he's talking about the big rotation from growth into value, away from the tech stocks into those cyclical stocks that are going to perform as the economy reopens. And our copper trade that we still have on is part of that, and part of our overweight to China more generally as well. China is the impressive growth story. They came out of the virus much more strongly. Their employment numbers are back up. Their production numbers are in fact far above where they were going into the virus, in attempts by the Chinese government to stimulate more and more industrial output to give jobs and give money back to the people. And so we've seen copper perform, depending on how you look at it. If you're looking now at the futures market, it's up in multi-year highs. Spot prices at a 2.5-year high. But we continue to hold copper due to this tightening demand and the fact that if economies are going to reopen, and if we are going to see a normalization back to where we were before COVID, these kind of cyclical base metals will continue to do well. And then I suppose we've taken some of that and we've moved it on to, in the equity side, an industrials play on US industrial companies. Again, the same idea that these companies, these metals and these materials used by these companies will be in higher demand as and when things get kicking back off again. And then what we've also done, I suppose, is we've avoided our exposure to oil for most of the year. That benefited us definitely through March and through April, but obviously there has been a slight recovery since then. Oil's trended back towards $40 a barrel. And what we've done is enacted a position it's called the Roll Select Bloomberg Commodity Index, which is effectively attempts to track the Bloomberg Commodity Index, but using specific caveats on the derivative futures, so preventing any calamities like the USO happening. So in other words, reducing the volatility we're taking in these commodity positions by rolling the contracts over a longer period of time. And so that's, I think, constructive on slightly stronger slightly stronger oil environment than we've seen for most of this year. Lots of big banks and analysts are now predicting that these inventory swells that we've seen are drawing back down slowly. And so we feel confident enough to dip a toe in the water there. because within the Bloomberg Commodity Index, we see about 20% exposure to those fossil fuel energy companies. And then also within that same index, that same position, you're gaining exposure to agricultural products. So that's the corn, the coffee, the soy, the sugar, all of which I think in a very constructive environment fundamentally as well, a weakening US dollar, inflationary expectations, food inflation, all of these positions should continue to outperform. They've done very well over the last month or two since we bought them, but that fundamental case I think remains intact moving forward. And in terms of liking more or less, there are I think two main areas to this. You have the short term, what do we like now as a fund, what are we invested in, and that's gold, that's copper, and that's that wider commodity index that we've talked about. But from a long-term perspective, things I mentioned at the beginning of the interview, electric vehicles, for electric batteries for vehicles, carbonization effects, hydrogen, water. These are the thematic long-term trades that personally I'd like to see happen. And I think within the next 3 to 5 or 5 to 10 years, these will be the basis of a lot of physical asset portfolios. These are the future of what is driving the next transition in our economy. Not necessarily play those all within the portfolios yet. We'd be too early on that trade, or the trade might be too niche for that. But what we're doing is we're leveraging our knowledge in other assets. For example, in silver, which we held for most of the year, its industrial uses in photovoltaic batteries, so solar panels. That's massive, and that's increased double-digit % growth this year. And then in copper, both for electric vehicles and also for now COVID, copper is one of the best repellents, I suppose, of COVID particles. So now there's talk of whole hospitals being made out of copper tabling and copper instruments and things like that. And so we're able to leverage those longer term themes into our portfolios today in a more tangible way. And then on copper as well, I suppose, again, China is now launching their own domicile native renminbi copper index, which is putting more upwards pressure on US prices. And so there's lots of things in the pipeline that will continue, I think, to support both the gold, the copper trade, and also on the oil side of things, you're seeing OPEC now come out and say, you know what, okay, yes, Libya and yes, Iran, they can produce all these barrels of oil, but there needs to be a cap on that. And I think we'll see a big event on Wednesday this week. I think that will determine a lot of what is going on with US oil prices moving forward. And then what do I like less? I suppose it's been interesting. This year's been one where you can see the pandemic's really exposed weak segments. That's within every asset class. But I think within commodities, it's quite clear because for a long time, for example, US shale, American shale production is an area that I particularly am focused in. We don't play that in the portfolios for the reasons I hope I'm about to say, but their break-even barrel production is much higher than that of Russia, much higher than that of Saudi Arabia and Iran, and Russia is sitting even below there. And so at a certain point, these industries which benefited from high prices and they were able to pump capital back in and grow these companies, that's not happening anymore. And you can see that through the rig count in the US, there, high hundreds rig count middle of 2019, and now you're talking about double digit. You're talking about less than 100 oil rigs in the US. And so that's an example, I think, of an industry that perhaps was maturing 5 years ago, and this was kick-started by the virus. And you can see that, you know what, this isn't going to work. And I think with the Biden presidency, which I think we're more and more likely now being locked in, despite whatever Trump may be able to do or not, that also doesn't bode well necessarily for US shale. There'll be higher regulation, there'll be higher caps on prices and things like that. And so I think that's definitely an area that I don't like as much. Residential and commercial property we've talked about, that's obviously half of what I do, but we've decided to neglect exposure to that area for most of this year based on the reasons I've given above. The work from home, residential stuff's all pretty priced in already. And obviously we're always still looking, and we want to find opportunity and find value wherever we can, but we're still in that stage with commodities and with physical assets where it's better to be safe, I think, than sorry. And you want to be capitalizing on gains, but you don't want to necessarily be entering trades based on what should be strong fundamentals, when in reality, fundamentals are not often what's been driving the market for much of this year.
Really helpful. Thank you very much, Jonah. There's loads that we can cover. I'm sure we can talk for ages more, but I'm conscious of your time. So I think we need to wrap up. I think there are a few things that we took from that. Loads and loads of opportunities. Of course, we're not without risk. There's risk everywhere we go. but it's really interesting and fascinating for me to get an insight into how your particular area of expertise feeds into everything else within the portfolio. It really emphasises the team effect and the team effort in running the Acumen portfolio. So we'll continue to do this. We'll continue to keep talking. I'm going to take away that gold and silver continue to shine, and that the batteries that go into electric vehicles are driving things forward. So those two phrases that you inadvertently slipped in will stick with me. Jonah, it's a real pleasure.
Thank you very much. I appreciate it.
Good luck with the rest of the Movember, and we'll talk soon. Thanks very much, Jonah. Cheers.
Yeah.